The tricky thing is how much can people get out and how much should they get out? And this is going to be very dependent on your property portfolio. But let's talk about how much you can get out. So there's different levels of LVR, and you can only take out a certain amount to a certain LVR. And Sam, I'm going to hand the microphone over to you for this one.
Yeah, well, generally, the equity when you're drawing equity out of one property, the 80% loan to value ratio is what banks work on, and you don't have to pay lender's mortgage insurance, which jargon LMI is that. If you don't carry loan to value ratio higher than 80%, so and that's also that's a risk assessment for the bank too. Like, everyone's obviously got certain risk appetites, and because property from the long term growth perspective is quite low in that risk sense, that people can go up to 90-95% loan to value ratios, even higher, especially in the past. They used to you can borrow the full amount plus stamp duty, which is insane.
And governments are getting close to doing certain things like that now, but we won't make this content non-evergreen.
It's always changing.
It's always changing. Yeah.
Yeah. So the whole purpose of the equity side, I would say, if you've got a current property, pulling the equity out on that, basically when I say pulling equity out is you've got a principal place of residence as an example, common one. It's worth $1 million now. You've got the $600,000 in debt. So you want to extract that equity out. What you'll be doing is going up to an 80% loan to value ratio. Therefore, you've got no fees involved from lender's mortgage insurance. And if you're buying another investment property, you want to try and reduce your fees as much as possible, but also not over leverage yourself too much either. And certain banks, they might do greater than 80%, but then there's you're reducing your potential pool of lenders, which getting a good mortgage broker on your side to have these conversations is really influential. But for simplistic sakes, stick to that 80% loan to value ratio for the drawing equity out component, and then on that $1 million asset that you're sitting on, $600,000 in debt, there's received $400,000 in equity there. But if you're going to that 80% loan to value ratio, what that is saying is you've got the $1 million in asset, 80% of that you can have in debt, so that brings up to $800,000. So you've still got the $200,000 buffer from the bank's perspective, which is healthy. But your debt now can go from $600,000 to $800,000. So what that means is you can then take that $200,000, basically the bank, you refinance it, the bank put it into your bank account, and you can offset your mortgage with that. Some people use that. A lot of people use that to go and use that as a deposit to go and buy an investment property. Other people might just put it in there just as access to cash if they need it. The biggest thing that people don't realise is that you're pulling your debt's going from
finance.
Yeah,
you're using finance.
Yeah,
is that what you're going to say?
Yeah. So it's money. It's borrowed money. So you're increasing your borrowing of money. So you're now no longer making the repayment on $600,000, which on a 6% interest rate, I ran some calculations on that. You're looking at $36,000 per year. So that's $690 a week. So cool. You're paying $690 a week to live in your home. It's worth $1 million. You've got $600,000 in debt in it. Yeah. You're like, cool. That's more than enough to make those repayments. And then you're like, well, I want to go to an $800,000 debt, so I can pull out that extra $200,000. That's meaning now you're holding $800,000 in debt. So your repayments again,
it's an extra $200,000 on that loan.
Yeah.
So your repayments are how much?
Well, did the calcs on that. So it's going up to $48,000 per year, which is $920 a week. So an increase of $230 roughly per week to have access to that $200,000 in available cash.